Long-term care insurance isn't for everyone. In fact, I'm going to share with you 5 really good reasons why you might not need it. And if any of these sound like you might be better off without a policy. But if you already have a policy and it's starting to feel like a burden, I'll share some smart ways to lower the cost without completely walking away. For those of you that don't know me, my name is Zach Morris, and I'm a certified financial planner, and I've been helping people retire for 14 years. So the first reason might be that you're more focused on living well today than preserving wealth for the next generation. And that's okay. If leaving an inheritance isn't a high priority for you, then financial decisions don't need to revolve around preserving capital. Instead of locking up money in long-term care insurance premiums you might not ever benefit from, maybe it's more important to keep that capital flexible so you can enjoy your life while you're healthy. Think about it. Would you rather spend $5,000 a year on insurance or a ski trip with the grandkids, or maybe a cooking class in Tuscany, or just upgrading your travel from economy to first class while you can still enjoy it? If you're more focused on living well today than on passing money down tomorrow, that's a good reason to rethink whether or not long-term care insurance fits into your financial plan. Now, the second reason is that you just have a strong support network. If you have a spouse, children, or a close family member who are willing and able to provide care, even just in the beginning, you may be less dependent on paid long-term care services. Now, no one wants to be a burden, but families who talk through care preferences and plan ahead tend to make smarter, lower-cost choices and often avoid unnecessary institutional care altogether. That said, failing to plan can backfire. It can lead to higher out-of-pocket costs and force your loved ones into rushed, emotionally driven decisions that are often more expensive than they need to be. Now, the third reason that you might not need long-term care insurance is that you're comfortable using Medicaid as a backstop. Now, this really depends on the state you live in and how viable Medicaid is as an option for long-term care. But for some people, relying on Medicaid as a safety net can be a reasonable part of a plan, especially if you've already taken steps to protect other assets. According to the AARP Long-Term Services and Support Scorecard, several states actually have highly rated facilities that accept Medicaid. And if you qualify, it's possible that your entire stay could be covered. So if you're in one of those states or planning to retire there, Medicaid might be a more realistic and strategic backstop than most people assume. Now, the fourth reason is that you have the assets to self-insure. So let's look at the numbers. According to the Department of Health and Human Services, the average man needs 2.2 years of long-term care, and average woman needs 3.7. So a private room in a skilled nursing facility costs around $120,000 per year today, depending on location. So if you grow that cost at 4% annually, that same room could cost $250,000 per year in 20 years. So let's do the math. For a man, 2.2 years times 250,000 is 550. For a woman, 3.7 years times 250,000 is 925,000. Total for a couple is 1,475,000. Now let's say you have a $2 million portfolio, withdrawing $75,000 a year adjusted for inflation, and your investments grow at a moderate 5% a year. After 20 years, you'd still have over 2.2 million. Even after those withdrawals and increasing those withdrawals over time. That gives you a cushion of more than $500,000 on top of covering long-term care costs. And this is before even considering selling your home. So that's the next point. If both spouses are in care, many daily living expenses go away. Things like home maintenance, travel, dining out, and utilities. Plus, you're likely to have a liquidity event from selling your home, adding even more flexibility. Bottom line, if you have a well-structured $2 million portfolio, it's possible you may already have enough assets to self-insure without needing long-term care insurance. Now, the fifth reason that you might not need long-term care insurance is that sometimes the math just doesn't add up for you. Let's say you're paying $5,000 a year for a long-term care policy. Over 20 years, that's $100,000 in premium. So let's say you're 60 and you might have a long-term care event when you turn 80. Now, what do you get for that $100,000? A typical policy might cover $225,000 of total lifetime care. So if you end up needing it, great, you profit $125,000 over what you paid in. But here's the catch. If you never need the care, that $100,000 is gone. Now, compare that to just investing the same $5,000 a year instead. If you earned a conservative 5% return over 20 years, you'd end up with about $165,000. So now ask yourself, would you rather pay $100,000 to possibly get $225,000, or would you rather have $165,000 saved that's yours no matter what happens? In this case, you're spending $100,000 to protect just an extra $60,000 in risk, and only if you need the care. For some people, that trade-off makes sense. For others, it doesn't. Now, let's say you have a policy and your long-term care policy is starting to feel like a financial burden, but you're not ready to cancel it completely. You do have options, and most people don't even realize this, but your current insurance provider might be more flexible than you think. You can start by calling them and asking them about ways to adjust the policy to lower your premium without losing all of your coverage. For example, you could increase your elimination period. That's the waiting period before benefits kick in. The longer you're willing to wait, the lower the cost. You could also reduce the maximum daily benefit or cut down on the total lifetime benefit. This gives you some coverage without paying for more than you realistically need, especially if you have a portfolio that can supplement your care. If your policy has an inflation rider or a death benefit rider, you might be able to scale those back as well. In some cases, you might not even realize that you have those riders on the policy. And if you've had a policy for a long time, here's something else to consider. Some insurance companies will actually make you a buyout offer, essentially paying you a lump sum to cancel the policy altogether. It's not always the best option for you and your financial plan, but it's worth asking about if the premiums are no longer manageable. The key takeaway is don't assume your only choices are keep it or cancel it. There's often a middle ground. You just have to make the call and start the conversation. I hope you've enjoyed this video today. If you have, please go ahead and hit the like and subscribe button and be on the lookout for more videos from this channel. Thank you.